Hi, this is James Kandasamy from Achieve Investment Group. Welcome to Investor Education webinar. Today we're going to be talking about real estate cycle, and we have Dr. Glenn Mueller, who publishes quarterly update on where different cities are in their different market cycles. So very excited to have him here. We're going to be doing some kind of like podcast plus webinar format here. So there's going to be questions being asked, Doctor. I mean, if you're listening and throughout the presentation, and at the same time, audience will be asking questions at the end. So for the audience who's attending webinar today, please use the Q&A box to ask questions. So with that, I'm gonna get started. And Dr. Glenn, welcome to the investor educational webinar that we always do to our investors. So why not you go ahead and introduce yourself, and let's talk about the real estate cycle in different cities and where they are in their market cycle.
Sure. Great. Thank you very much. And as you can see here, I'm now an emeritus professor at the University of Denver. I've got 48 years of real estate experience. We also have a program for wealthy families called the Bailey Family Enterprise Program, um, where they get together and think about investing and how to work with families and things like that. And then I'm also a director at Sharing Connection, which is a nonprofit that helps to fund affordable housing. So if you're interested in affordable housing and you need help with funding your development, Sharing Connection does that kind of thing. So, excuse me. What I want to start with is we're going to talk about real estate cycles. And to me, real estate is sort of a delayed mirror of the regular economy. And so, because of that, there are five major economic factors that the drive real estate, and the demand drivers are basically population growth. People use space. And every place you go, people are in buildings to live in, work in, shop, play, sleep, pray, store stuff, whatever. Um, Second is the growth of the country, and GDP, or gross domestic product, is really like the profit of a company. And if you look at the output here, what I want to do is have you look at previous cycles, and you can see that back from 97 to the Great Recession of 2008 and 9, GDP grew at about 3.2%. Between the Great Recession and the COVID recession, GDP grew at 2.3, and the forecast going forward is for about a 1.9% average growth, so a slower growing economy. Part of that is because we have slower growing population growth. But the number one thing to look at when you're interested in real estate is employment growth, because when people get a job, they have to work someplace. And you can say, well, what about the person working from home? And the answer to that is, but then there's a server hotel where the computer and storage for the work they're doing is being held, and that's actually one of the new big sub-property types now is computer storage, or computer hotels, if you will. And if you look at employment growth, same kind of thing, 1.3 in the previous, 3 decades ago, 1.4 between the Great Recession and COVID. And then now going forward, less than that at 0.6%, still positive growth. But the reason for that is that there are just more baby boomers starting to retire. So that number is going up, while the number of millennials coming out of school is flattening out. It's still a positive number, but just not as strong as it's been in the past. Okay. On the cost side, we care about inflation. And it was 2.6 back starting in 97. It dropped and was very low at 1.8 in that second segment. And then you can see here that the forecast is probably a little bit stronger at 2.5, but still not as bad as, still not as high as it was back uh, in the 90s and early 2000s. So I think we're coming back into a period from that standpoint. And then, of course, interest rates. And we use the 10-year Treasury rate, which is known as the risk-free rate. And in commercial or income producing real estate, Um, you don't finance for 30 years like a house. The maximum is typically 10. And you can see that interest rates were running 5%, and real estate was doing well back then. Came to the lowest number that we've seen in over 60 years at 2.4 between the Great Recession and COVID. And now going forward, the forecast is, 3.8. And we expect that because the Federal Reserve still hasn't really dropped their rates much, and the 10-year Treasury today is bouncing just a little bit over 4%. The other thing to think about is looking back at the long term, what you see here is GDP and employment growth. We have kind of long 5 to 10 year um, growth periods and very small, short 6 months to a year, maximum year and a half recessions. And so the forecast is for kind of a typical 10-year growth period going forward, which I think is somewhat reasonable. Okay. The other thing is that demand for real estate really is going to follow employment growth, as I had said before. And the black line here is employment growth. And you can see three different sectors here: office, industrial, and retail. And they're all growing together. The only one where there's more square footage growing than employment is in industrial. And the reason for that, as you all know, is the Amazon effect and the fact that we just have so many more options today, so much more stuff than we used to. When I was a kid, I had two choices of cola. It was either Coca-Cola or Pepsi. Today, I've got Coke, Diet Coke, Cherry Coke, Vanilla Coke, Lemon Coke, Lime Coke, Coke Zero, and on and on and on. And so we've got to store all those extra options. And that's one of the reasons that we need all this additional space. So back in the early 1990s, I got hired away from the University of Denver to work at Prudential Real Estate Investors. At that time, they were the largest investor in commercial real estate in the country. They also managed money for a lot of pension funds and endowments. And of course, the largest fund in our country is CalPERS, California Public Employees Retirement System. It's a $500 billion fund today, and they allocate about 12 to 15% to real estate. And 1990 was a recession and a crash in real estate. And Prudential said, figure out what happened, why it happened, whether or not we can model it and understand it, and maybe even forecast it so we can make better investment decisions. And what I found was there's really two parts to the cycle. The physical cycle, which we're going to talk about first, which is demand and supply for space, that drives occupancy. Occupancy drives rent growth. And if you think about it, if my occupancy goes up and my rent goes up, my income goes up. The other side is the financial cycle, which is the price that you're paying for real estate. And that's driven by capital flows. And we'll talk about that a little bit later. So my model basically I took the 54 largest cities in the country and I modeled their historic rent growth, and found that they typically cycle, or their occupancy. The graph you see here is an occupancy cycle, and that real estate cycles were lasting about 16 years. That's why there's 16 points on the graph, and um, that's typically two economic cycles. And you can see that when you're at the bottom at point one, point two, when you've got too much of anything, when you've got too much space to rent out, you're going to drop the price. As we start coming through that recovery phase there, phase one, rent starts to grow. When we hit the long-term average there at point six, we're going at about 4% rent growth, which is the rate of inflation during this time frame. And this is notice 1968 to 1997, so 30-year forecast. In phase two, the expansion phase that I've got in green, you can see rent growth growing faster than inflation, hitting its highest rent growth at point 10 at a 12.5% rent growth, and then starting to slow down or decelerate, not go negative yet, but 11, 10, 6, back to just a little bit better than inflation at the long-term average at point 14, and then low and negative at the bottom in the recession phase. Just updated the study through 2023 as well. and the results are very similar. Low negative at the bottom. Inflation was low in this last 20 plus years, so only 1.7 and zero point 0.6. Highest rent growth at the peak at 0.11 at 10.3%, and then it starts to decelerate again and ends up going low and negative in the recession phase. So if you knew where you were in the cycle, wouldn't that have you make better investment decisions, property management decisions? Is now the time to rehab my lobby in my office building? Or is the demand so strong and we're in the growth phase that I ought to be pushing rents higher? So what I do is I cover the major five income producing property types, and I look at where they are every quarter in their cycle. So you can see here that industrial and all the retail and hotel are in the growth phase. Apartment is in the hyper supply phase, which means we built a little bit too much. And as you would guess, office, both downtown and suburban, is at the bottom with the lowest occupancies actually that we've ever seen in office space. I also break it down then by city, and I cover the 54 largest cities in the United States. And for office, you can see that they're spread all over the map. And that's because of the amount of demand and supply that are coming together in any city. Cities move differently. What's driving Houston, Texas, the oil industry is not what's driving New York City, which is finance. And so as we look at this, you can pick the city that you're in and see where things are moving. I have Denver highlighted here just because that's where I am. And we'll watch Denver as we go through the different property types. There's two other things that you should know about this cycle graph. Number one is that you see that I've got numbers behind some of these. And the numbers basically tell you where that city has moved since the previous quarter. So this is third quarter 2024, and what has happened since the second quarter. San Diego, Seattle, as you see here, we're over here at 0.16, and they moved forward to 0.1 during that cycle. Columbus was at 1 and its occupancy improved, so it's now up to 0.3 on the cycle, or moved ahead 2 points on the cycle. Sometimes um, markets will be moving up and then they'll move back down, like Milwaukee -1 and Raleigh Durham, where their occupancy level was moving forward and dropped back a little bit. That could be because loss of some jobs in that city, or it could be because of some new properties coming online during that time frame. The other thing that you'll notice is that I have some cities in bold and italics. Boston, Dallas, Houston, Los Angeles over here at point 0.1. And the reason for that is that there are a small number of cities that are so much larger than the other that they make up a large portion. So in the office space here, you can count there are 11 markets that are in bold and italics. They make up 50% of all the square footage in all of those markets. So they are actually driving some of what's going on. And the national average, I think, is sitting at 0.16, working its way down. Okay. When we go to industrial, you'll see that Denver, which was at 0.16. When we go to industrial, Denver's at 0.12. Very different demand and supply. Half the markets are at the peak. Obviously, the Amazon effect has driven demand for new warehouse space. We started to overbuild that a little bit when COVID hit, because demand for warehouse space jumped massively during COVID. Amazon, had, the leader here, online retail sales over the years went from 8 to 9 to 10 to 11 to 12%. COVID hit and they jumped to 18. That's a 50% increase. Amazon started leasing all kinds of additional space and having space built for them during COVID. And then when COVID subsided a year later, that demand dropped back to 12.5%, and it started back to its normal growth in retail sales. So Amazon literally let go of some of its space and things like that, which created a little oversupply in the market and made things happen. So you got a number of markets that are just a little over the top, or we've got just a little too much space at the moment. But with the economy moving back, I wouldn't be surprised to see many of these markets move back here, like Baltimore did, back to their peak occupancy. I don't think we're going to see it roll down through hypersupply and into recession. When we look at apartments, you'll see that now Denver is at point 14 on the map, the nation at point 13. We have a lot of cities where demand has been strong and they're at their peak occupancy here at point 11. A lot of markets in the hypersupply phase where we built just a little too much. And by the way, when I say we built a little too much, it's mostly Class A downtown space that has been being built. And that demand, there's only so much of it. And in many cities, rents went up so much post-COVID that it made it less affordable. So that actually pushed demand down. And the easy way to explain it is one of the young ladies working with me at my company back then, Black Creek Group. She had been living in downtown Denver in a studio apartment in the newest, nicest building in town with two swimming pools, an LA fitness style gym, full commercial kitchen with a once a week guest chef coming in to teach a class, et cetera, et cetera. And, she was out on the town. She could walk to restaurants, bars, music venues, everything you can think of during that time frame. And it it was great. She was paying $2,000 for a month for that and walking 3 blocks to work. Um, COVID hit and she couldn't go anyplace, couldn't go to work, had to sit on her bed to work during the day on her computer. So she and some friends rented a house out in the suburbs. And when COVID was over, she came back to the building and said, "Can I come back in?" They said, "Yep, you can have your same unit back, but now the rent is $2,500. That's a 25% increase in 1 year." She thought she couldn't afford that, so she and one of the friends she had been in the house with rented a two-bedroom for $3,000. Hence, she's paying less. So if you think about that, that's one less household formation and one less unit demanded of apartments. So that's part of what's happening
Yep.
due to the higher rent increases.
Doctor, one question. Do you track absorption rate as well? Because I know like some of the market here, something like Austin and Dallas, they have high absorption rate because that's going to show how fast it moves or potentially moves between these points, I guess, right?
That is correct. Yes. Yep. I have the absorption data. And like I say, demand and supply mixed together to basically give me absorption, which then gives me the occupancy level. So yes, that's one of the key components in the model. Great question. Retail, you may all be surprised, but retail, basically every city in the country except San Francisco is at its peak occupancy. Reason for that is the Amazon effect has been harming retail, if you will, for over a decade. And so the amount of new retail being built has been very low. I mean, less like half of what it used to be in many years past. And also, we've seen a lot of existing retail getting converted to other things like literally office space 10 years ago, apartments, sometimes storage, etc. And so it was hard to get a loan to build new retail. In the last 2 years, 80% of all new retail built was already pre-leased. Someone said, "I need this, please build it for me." So retail is at a peak pretty much every place. And then hotels, as you probably know, uh, they had a massive shutdown during COVID and have bounced back pretty well. But we have different types of hotel. We've got basically business hotel, conference hotel, and then leisure. Leisure came back very, very strong. And while a lot of these markets have moved up, conference has now come back very strong as well. Business not as much yet because flying to another city to meet with someone when they're not in their office typically isn't happening. Okay. So that's where we are. What I want to do is kind of walk you through and talk about where are we going and show you how I kind of develop forecasts of what's going to happen in the future. To do this, I'm going to go back into the 1970s and we're going to take a look at demand and supply. And you can see that demand, the yellow bar there, was growing at an average rate of about 2% in the first half of the 70s, while supply was growing at 5. More demand, more supply than demand means occupancies are dropping off. 1976, you see more demand than supply, and so now the occupancy cycle is going up. Go to the 1980s, and you see that in every single year there was more supply than demand. We oversupplied office massively during that time frame. Okay. As a matter of fact, the average during the 1980s was a 7.7% growth in office every single year. And that is a huge number. Another fun fact is that we doubled the amount of office space in the United States in 1 decade. 7.7% compounded over 10 years is a double. Demand, on the other hand, was growing at 3.8%, which is less than half of the rate of supply growth. But that's actually the most incredible thing on this graph. You go, wait a minute, why is that incredible if it's less than half the supply? And the answer is that the population in the United States was growing at 1%. Employment growth was growing at 1.6 because we had a lot of baby boomers coming out of school and getting jobs. So it was a decade of high growth. But office demand was growing at double the rate, more than double the rate of employment growth. And the reason for that was the United States shifted from being a manufacturing country to a technology-driven country that uses office space. Back in 1960, 25% of all people working in this country worked in manufacturing. Today, it's 8%. Back in 1960, only 6% of all people were working in office space. Today, it's over 30%. So that change in how our economy moves and grows was a major factor and one of those big macro picture things you always want to be watching. Okay. 1990s, flip of the 1980s, more demand than supply every single year. And as a matter of fact, almost no supply here, 92, 93, 94, less than a half a percent. And finally, in 1998 and 1999, we get demand and supply matching up nicely. And as you probably remember from your old Econ 101 class, that is equilibrium. And that would be the peak point on my occupancy cycle, peak point 11. Go to the 2000s, you can see that we had a tech bubble that burst. We had actually negative demand for office in 2001, the first time ever. It recovered and was over 2% by '05, dropped back off, and in the Great Recession went negative. And you can now see demand dropped and then started to pick back up while supply slowed to 2004 before it started to pick back up. So that differential movements helped create even more of a cycle, if you will. And then as we look at the last decade, 2011 to 2020, you can see more demand than supply all for the first half. Nice equilibrium in 2016, and then more supply than demand up through 2020 with the negative year of COVID. And going forward, what do we see but more supply than demand in the past few years and continuing here into 2024 and still getting close there. And you go, wait a minute, office has been bad since COVID. Why would we have that amount of supply? It's about a half a percent, so it's a very small amount. But remember, in downtowns, it can take 8 to 10 years to have an office building go. So something that got started pre-COVID in 2019 may not be completed until 2028 or 2029. So there are still office buildings that are being completed, even though there isn't enough demand there. So we can look at the office occupancy, the red line here, a peak, which would be my point 11 on my graph, a bottom here, 86 to 91, another peak in 2000, the tech bubble burst, and that dropped it down to 2023, a small peak in 2007, a bottom during the Great Recession, a peak in 2019 just before COVID hit. And you can see we've got a high equilibrium number, 95% occupancy, a lower 92% occupancy, a 93.5% occupancy. And we see obviously office occupancy dropping off here going forward. And then rent growth, you can see that they follow each other fairly closely with a correlation of 79%. So my forecast on office is that third quarter of 2025, a year from now, most of the cities will be sitting at the bottom with a number of them recovering and moving forward. Most of these didn't have much new space being constructed, and the economic drivers, the economic base industries that drive growth in these cities, is stable enough to create some additional office demand. When we look at industrial, we see the same, cycle following the economic cycles, and we see the same kind of rent growth correlating to occupancy levels. And we had, a peak back in 2019. It did drop off a little bit during COVID and then came back to a peak that is coming down now just because of some overbuilding. And so again, about half the markets at their peak, and the other markets in the hypersupply phase, with a few down in here. And you had asked about Austin. Texas is a place where it's very easy to build, so you end up getting a lot of space being put up very quickly, and so they're one of the more oversupplied markets today in the country. And when we look at apartments, same occupancy cycle following the economy, with that post-COVID peak in 2022 that has dropped off. But notice that this is 95.5% down to all of 92.5%. That's only a 3% change in occupancy. And you can also see these are quarterly numbers here, that rent growth is seasonal, is the best way to put it. In other words, it's different during different quarters. Summertime being the strongest demand time where they can raise rents. Christmas time being not quite as good because people don't want to move during holidays, those kinds of things. Um, so when we look at that, we see again, a number of the markets, at least a third of them at their peak, most of them in the hypersupply phase, and a few markets that are well oversupplied and have very, very low rental growth. But rent growth is still happening. Today, it's about the rate of inflation. Look at retail, highest occupancy ever at 96 and a quarter percent here in 2024, with the forecast that it's going to stay up that way. Notice though that rent growth was growing as well, and a little bit of a drop off here, just as a lot of leases were expiring, and to keep people in and not have to release the space, dropped. Still positive, but not very strong. And again, all of the markets except San Francisco and East Bay outside of San Francisco, in their highest peak occupancy level. And then hotels, as you would guess, very seasonal. So what I have here is kind of the high season number, the loss during COVID, and it's working its way back. And actually, if I annualize it, you can see that peak in 2019 at about 65% occupancy, dropping to 38% in 2020 with COVID, and today running close to 70%, which is a new all-time high for hotels. So they're all working their way up, most of them in the growth phase. If you've gone out for hotels lately, you've certainly seen, higher room rates happening. So again, that's the first half of the real estate cycle. Demand and supply drive occupancies. Occupancies drive rent growth, and together that produces the income on any of your real estate investment. Now let's talk about real estate prices. Capital flows
Doctor, I just
affect
have one question.
prices.
I mean, on the
Yep.
because a lot of our audience invest in apartments. So can we just quickly look at the apartment slides? Because I just want to see when we expect the apartment market cycle to recover.
Yes, good idea. Okay. So we'll go back one more. So, literally, I think we've seen that bottom in second quarter of 2024, and we're starting to see occupancies starting to pick up again. Again, what we have is an oversupply of Class A. We are in dire need of Class B and C affordable or workforce housing. Every city in this country is short in that, but you can see it climbing back up. And we're talking about occupancy going from 29 or 92.5 by 2028, 93.5%. So that's only about a 1% increase. It's always been a Occupancy is typically always very high in apartments. If you were to build a new apartment building and it wasn't leasing up fast enough, all you'd have to do is drop rent to be equal to, you know, older space, and people would move, where they don't have to pay anymore, and that would help you get filled up and stabilize your occupancy. So, apartment hands down over the, past 50 years that I've got data on has been the least volatile and the most stable of all the property types. That answer your question?
Yeah, if you look at one asset class that you think is the best time to invest right now, what would that be?
Um, well, let's talk prices, and
Okay.
and that's a perfect segue into just that. Okay, so again, capital flows affect prices. When the economy is looking good and companies are making more profits, we call it risk on, and people put money in the stock market, and as they buy stocks, stock prices go up. When there's a problem, any risk, any danger, things look bad, people pull their money out of the stock market and put it into the bond market, and bond prices go up. Okay. So if we look at the world, US real estate, and this is income producing real estate, not houses, 18.7 trillion is about 22% of the total universe, with equities, stock market, and bonds making up the rest. So it's one of the major three asset classes to invest in, if you will. If we go back and look at the 10-year Treasury rate, which again we use as the risk-free rate, right? You can see that back in the early 50s, it was running, around 2 to 3%. It rose all the way to 15% in 1983, and then slowly worked its way back down to the absolute low here in May of COVID just starting was 0.4% for a 10-year Treasury bond, which is basically nothing. It has bounced back up into the 4% range now and looks like it'll be there going forward. Bonds are the one place, in my opinion, that you do not want to be when interest rates are rising. And the reason for that is this simple. When you look at the average yield over the entire time frame, you see that the 10-year Treasury has averaged about 5.8%. And today we're running like 4.25. Okay. The average total return, because remember, the total return on any investment is made up of two parts, income and price appreciation, right? So notice that between 1981 and 2002, the total return was 8.6. How can it be higher than 5.8? And the answer is simple. If I were to buy a bond with a 6% yield for $1,000 and interest rates drop to 3, my $1,000 bond can now be sold for $2,000, a 50% decrease in its value because the new buyer is only expecting a 3% yield, not a 6% yield. Well, it's just the opposite when interest rates are going up. From a bottom here, from 53 to 73, the average total return on bonds, even though the yield was 5.8, was 1.9, and between 1953 and 81, when it peaked at 15, was only 3.9. Because if I have a $1,000 bond with a 3% coupon and I have to sell it because rates went to 6, it's only worth 500 bucks. So I just lost half of my principal. And actually over here, I'm sorry, I sold the bond over here for $2,000, double to get the 3% yield. Sorry about that. So I have a zero allocation to bonds because of this. Okay. So as I said, it's capital flows that affect prices. So Moody's, the big bond rating company, bought out a friend of mine, his company called Real Capital Analytics. He started collecting data on every single income producing real estate transaction in the United States over $2.5 million back in 2000. And what this shows you is transaction volume. It's like trading volume on the stock market, if you will, at $20 billion dollars in the first quarter of 2001, peaking at $160 billion dollars in the fourth quarter of '06, during the Great Recession, dropping to about 15 billion in '09, going over 160 a number of times since then. And during COVID, it only dropped to about 60 or 50 billion right here, and then has picked right back up. And then they produce a price index for it, just like the consumer price index. This is called the Commercial Property Price Index, or the CPPI, the orange line here. Volume goes up, prices rise. Volume comes down, prices drop. Volume goes up, prices rise. So now I can break this down by property type. And so and notice that from its bottom here in 2010, prices are up 165%. Okay. So, and that only took you through 2002. This is the most recent, if you will. And you'll notice that with the rise of interest rates recently, property prices, whoops, get out of that. Property prices dropped. And now, just in the last 2 quarters, it started to pick back up. And so far this year, property prices are back up 4% because of the drop in interest rates. Okay, so now let's break that down by property sector. At the top, manufactured housing, in other words, mobile home parks. Number two, highest, price from 2017. Industrial prices are up, what is that, 70% or so. Self-storage up, came up, came back down a little bit, still up 40%. Strip retail up 10. Lodging up 5. Negative, triple net lease, and obviously office and regional malls both hurting. So if you want to buy a deal, you might consider office or a mall. As a matter of fact, one of the big things happening today is a lot of opportunistic money going after buying an office building and converting it into apartments, if it makes sense. But I've been to a couple of seminars on it, and right now, maybe 25% of the office buildings out there actually are economically qualified and in the right locations to be able to be converted into apartments. They have to have a certain floor size and this kind of thing. If they're too big, you just can't have, everybody's got to have an outside window, and you can't have, a 10-foot wide, 100-foot deep apartment. That just doesn't kind of work. So different ways to look at that. Okay.
So the
So
previous slides, it doesn't really show on the slide that's going up by 50% for retail mall and strip retail. Am I reading the chart wrongly?
So starting here at this point, we've got a negative. We've got a negative. They dropped off a little over 40%, picked
Got it.
up a little bit, it came back down. So net
Okay.
net, they're down 38%.
Oh, got it. Got it. This is per annum chart, I guess, right? And
Yeah, this is an annualized price change.
got it. But if I look at from last year to this year, I mean, the biggest change from what I see here is, am I reading it correctly? Does the apartment, the green one, start to pick up from 2023 to 2024? Yeah,
So yes, from 2023 to 2024, we went from, kind of a 0% change and now up almost 10%.
got it.
Yes. So demand for apartments as the safest of the property types is coming back and people are buying.
Yeah. So if we just look at the past 1 year, I mean, if I'm reading correctly the chart, I mean, it shows the apartment as the strongest comeback, I get 2023 to 2024, I guess. Is
You
that
are
right?
correct.
Okay. But if you look at past since 2017 to 2024, then you have strip retail and retail mall is going up. Okay.
Right. Right. Yep. Good analysis. Okay. And of course, we express real estate prices using cap rates. And obviously, the easiest way to describe that to somebody who doesn't know is it's the cash on cash return, or it's just like a bond yield, right? I bought this bond with a 3% coupon. I'm getting a 3% yield. You can see that cap rates in back in 2001 were averaging in the 9% range. They dropped down into the 6.5% range in '06, '07 when prices had gone up. And then the Great Recession hit, prices dropped, and cap rates were back up in the 8% range. And then they've been working their way down over the past almost 15 years and only recently have started to turn back up, or prices moving up, with the interest rate increases. When you look at this chart, you say, "Wow, real estate looks expensive historically. It used to have a much higher yield." And that answer is true, but we're also in a lower yield, a lower interest rate environment. So the correct way to look at it is how much more return am I getting over the risk-free rate of the 10-year Treasury for taking the risk of investing in real estate? And the answer to that is the spread over the 10-year Treasury used to be about 3.5 to 4%. It dropped to only about 2% here in '07. Since then, it's been hanging more in the 3.5 to 4 and potentially even higher. So for instance, for apartments, 3.5 in industrial, because they're the most solid of the property types right now. We're talking 5% for retail and 6% for office and 6.5% for hotels. So on a relative basis, in other words, I got to invest my money today. The stock market has a dividend yield, the S&P 500 of 1.5%. The 10-year Treasury is around 4, and you're getting another, 3% in in uh, in the real estate space for making those investments. Okay, so financing drove prices in 2023 and interest rates doubled, making it less feasible to purchase. And low transaction volume, we got some markdowns, right? Fed lowering the interest rates will help some, but not all. And in 2024, debt maturities are creating a lot of forced sales of properties, foreclosures, and there are some out there, and even in apartments, or the loan or the bank extending the loan and leaving the interest rate where it was, type of thing, right? But there's lots and lots of capital out there waiting to buy at the bottom. They're just hoping for lower prices. And I'm not sure that we're going to see much in the way of lower prices, except maybe in the office sector at this point. Okay. And finally, um, I need to tell you that the world has gone through a lot of changes. When I started in this business in the '70s, doing commercial real estate, local buyer, local seller, local bank doing the financing. The 1980s, the institutions, these pension funds and endowments came in and started putting real estate in their portfolios. National buyer, national seller, national financing became available. In the 1990s, the next decade, we got access to the public capital markets, the stock market through REITs, real estate investment trusts, and the bond market through CMBS or commercial mortgage-backed securities. And that actually lowered the cost of capital for real estate. But since the year 2000, real estate's gone global. Now we have foreign investors, especially institutions like pension funds, coming from around the world buying our properties. Norway has the largest pension plan in the world at, I think it's getting close to $2 trillion. All of the Arab oil countries have pension plans and investment plans and endowments and things like that. And they come to the US to buy our properties. And as a matter of fact, I was at a conference talking to an Arab once and said, "So what's your holding period? How long do you plan to own this property?" He kind of looked at me funny and went, "We plan to hold this forever. We're buying this to create income because we know someday we're going to actually run out of the oil under our ground. And when we do, we need income from other investments. So this is a buy and hold forever investment for us." So this shows you cross-border capital flows. I mean, in other words, money going around the world. So in 2023, the United States invested into Germany $11.8 billion, which was a 27% increase over the previous year. Germany, number four here, invested into the United States $5.6 billion, which was a 1% decrease. And why would that be? And the answer is very simple. Anytime you go international, you just added one new layer of risk, and that is the exchange rate. The dollar became stronger in 2003 and the German mark and the euro down, right? And so that looks cheaper. Okay. I can buy that property for less dollars than I could have last year. But I think the reason why I believe that you'll see foreign investors constantly come into the United States is number one, we are the largest market in the world. We're also the most politically stable, and we're also the largest economy in the world. Okay. So, fun story for you. In 2019, just before COVID, a office building in New York City sold for the highest price ever seen. It was a five, excuse me, it was a 4% cap rate. Okay. In London that same year, 2019, a Class A office building went for a 2% cap rate or double the price of New York. And in both Hong Kong and Tokyo, Class A office buildings were selling for a 1% cap rate. So to an Asian investor, US real estate looks like a 75% off deal. To a European investor, it looks like a 50% off deal. And so they are coming into the really large markets, the ones I had in bold and italics, buying and owning and operating those properties. A lot of US institutions, pension funds, and endowments are moving into second tier cities like Denver and Austin. And a lot of wealthy families are moving into smaller third tier cities where they can get higher yields. So, uh, my summary, real estate and economic cycles can be either long or short. I think we're in for a long cycle. We're a couple of years into potentially a 10-year cycle. GDP growth was negative, then positive, then negative, then positive. Where is it going from here? But employment's been strong. We are at a very high employment rate. We keep adding jobs. We need more people, but we keep adding jobs, which is good, right? Real estate cycles can be driven by either demand growth or supply growth. So that is very local in nature. That's why those markets are spread out all over by property type, because, you know, adding more office space doesn't hurt industrial or apartment or anything else, right? So we're in a growth phase in a lot of property type and markets, but it's very dependent. And that's why knowing the cycle for your market is very important. On the financial side, capital flows drive prices. We've had a volatile stock market, but now keeps hitting new highs and higher interest rates. The black swan event, if you will, that creates a risk perception was COVID, then a few bank failures, and then international wars, and then the collapse of office. And I don't know what's next. If I did, I wouldn't have to be working anymore. Okay. So, in real estate, what you want to do is find safer tenants. And if your major focus is on apartments, it's, what job does your renter have? Are they tech jobs, that type of thing? One of the things to do is watch the biggest uh, companies in your city and what they're doing and how they're doing and how their industry is doing, because that'll help you know whether or not your local economy is going to be driving and moving forward, because safe tenants create higher demand and therefore higher income for you. But also know that the world is just awash in cash. Everybody was sitting on a lot of savings that drove prices up, but transactions literally stopped in 2003, but have started to pick back up because interest rates have started to come down. Um, if you're buying single family housing, the nice thing there is you can always refinance the house at a lower rate with no penalty. In commercial real estate, when you go into refinance, they typically have, you got a 10-year loan, but they have like, you can't refinance this, you can't pay it off early for 7 years, which is called a lockout, or there is a penalty or what's called yield maintenance. You're going to pay us extra cash because if we lend you money at 5%, and now we can only reloan it at 4 if you pay us back, that you're going to pay us a 1% penalty to make up for the income that we've lost. Um, Conservative debt financing in the past cycle, I think, averts a banking crisis going forward. It used to be easy to get 75% loan to value financing. Now 60 is more the norm. Um, Higher interest rates and cap rates, have created a price decline, but cap rates are starting to move back up a little bit, right? And amazingly enough, there are some institutional office owners who defaulted on and gave keys back to lenders. Um, and make sure that in everything you do, you differentiate between home ownership, which is a use asset. You live in it, you don't live on it. And just like your car, you need it every day. You have to maintain it, put in gas, electricity to run it, etc. And if you sell it, you got to replace it, kind of thing, versus income producing. So if you own a bunch of single family homes, they are really in the, if you will, rental housing market, which is apartments. They're a competitor to an apartment. So that's that's my story, and I can open it up for questions.
Yes, for those who have questions, please use the Q&A box to type out your questions and we'll get it answered. But I have a couple of questions. So, Doctor, I think we just had the election with the President Trump coming to the office and he has his nominations for his cabinets, right? So, based on what you see in terms of the policy and the nominations, like some of the, interesting nomination, like the new HUD secretary and the potential extension of the Trump tax cuts. How do you think it will help out in the real estate business and which asset class would be favored?
Okay. So, first of all, Trump being a real estate person was very good to real estate in his previous presidency, and I believe that that will continue. We know that there is a large um, housing shortage, affordable housing shortage out there. And interestingly enough, you may remember that Kamala Harris had proposed a $25,000 stipend to help first-time home buyers. But I have heard many economists say that is the absolute wrong thing to do. And the reason for it is you have a supply side problem. We have a shortage of properties. We have plenty of people out there demanding it, but the prices are too high. And if we all of a sudden bring a bunch of people that didn't have a good down payment, they're now getting it for free competing. I just increased the number of buyers, and that's just going to increase prices. So they said that that was the absolute wrong thing to do. I think what we'll see with President Trump are incentive plans that allow more affordable housing to get built. As you may all know, one of Trump's biggest things was the Opportunity Zone legislature that came through. And most of you know what a 1031 exchange is. You sell a property, you can 1031 into another property and defer the taxes until you eventually cash out. The Opportunity Zone allowed you to do anything, sell a business, a stock, a bond, a commodity, and take just the profit and roll it into an Opportunity Zone. And you had to build something that employed a minimum of 10 people. And Opportunity Zones were designated by every state with typically low income areas or whatever. So I sit on the board of an opportunity zone fund called the Arden Group, and we did some student housing in Las Vegas. We did some low income housing just outside of New York and that type of thing. So I think you'll see um, incentives for both investors and developers and builders to do a lot there. Um, I I don't see a lot of, well, I think a lot of cities are already giving incentives like tax write-offs and or no taxes to pay for 10 years if you convert a office building into apartments, et cetera. So I think we're going to see the most emphasis on apartments.
Do you think it's going to be more on the affordable housing space and ground up construction, like brand new ground up construction? And how is that compared to like buying existing apartments, class B and C, and probably class A as well?
Well, Class B and C are definitely in high demand and have higher occupancy rates. So if it financially works well for you, I think you'll be just fine there doing that. Um, uh, the problem is construction costs because of material and labor costs going up are very challenging today. So unless there's some way to, change that, again, the demand's high and the supply is somewhat low. So that's the real challenge of how do we actually develop um, affordable housing when the cost to build is higher right now. I believe, and I've seen a couple of studies looking at it saying that we're we're still today at a uh, lower price to buy an existing property than you could replace it with. And from that standpoint, even publicly traded REITs are actually trading below, their liquidation value if they were to be sold off in the private market.
Got it. Do you think the 100% bonus depreciation is coming back for
Um,
yeah,
that would be an incentive for people to buy, whether that creates enough extra value building something new, I'm not sure.
got it.
If it was tied only to new construction, yes, that would be valuable.
Okay. Okay. And where does the small town surrounding these cities tend to lie in relation to the cities that you have chosen in your data, right? So, I mean, I'm talking about Austin means if Austin suburbs, right? How does the suburbs benefit compared to the cities?
Okay, so the data that I used was the metropolitan area, so it includes all the suburbs. But in the U.S. today, a company called CoStar, which is where I get my data from, they cover 396 cities. Okay, like my hometown of Oshkosh, Wisconsin's like 60,000 people, but it's 80 miles from Milwaukee. So there's data on smaller cities and towns and that kind of thing. And again, it's all demand and supply. If I have a small town, what is the economic base industry? What's the industry that drives that growth, right? Is it a single manufacturer? Is it a resort town? What is it that's driving demand and driving employment growth? And is it growing at all? Are kind of the things to look at.
Got it. Got it. Got it. Yeah, I think these are the two questions, and I have a bunch of questions, and it's already like, more than an hour you being with us. Um, Thank you so much for coming and giving us a really good, excellent presentation here.
Well, thank you. And if you got kids looking to get a degree in real estate, University of Denver has the second oldest program in the country. We also have a master's program, and I get a lot of people coming in for that. And then we also recently started an executive PhD program if you feel like getting a PhD.
Wow, that's cool. All right. Thank you, doctor. Thanks for coming.
All right, thank you. Merry Christmas.
Merry Christmas. Thank you. Bye.